Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today, Monday, May 19th, 2025. I'm going to share a few disclosures with you guys, as usual, in the chat. Great to see everyone. As usual, you can also go to tradestation.com. And if you scroll down the page a little bit, you'll see a blog post with the title of today's webinar about politics and a picture of me. And then you can go to that. It will have some information about the main things we're going to be talking about. So you go to tradestation.com. Actually, it does not have a picture of me. It has a picture of Wall Street there if you want to look at that blog post on tradestation.com. Here are the standardized returns of some ETFs we're going to be talking about. And, today is interesting. I'd say that when we look at the overall situation right now, to me, we have a lot of things swirling around with politics. And the market is a spot where it's essentially seeing that things are on a degree of upswing with the tariffs. There's a little bit of acrimony today I saw between China and Trump and things like that. But essentially, the market at this point sees things on the upswing and things more going back towards some direction of normalcy, some direction of not too much trouble in terms of the what tariff rates will ultimately be. We're more or less in a spot where this tax bill is now moving through Congress. It's not super clear exactly what and when and how it will happen, but we've been through this before, and at this point, the market is kind of has confidence that an acceptable outcome will occur. And then we had the Moody's downgrade on Friday afternoon. For me, that is also not a hugely important thing. I think everyone knew about it. Um, the other two agencies had already taken us down from AAA, so it's not that important. So if you go here to this blog, so if you go on tradestation.com, just to be clear, here's the main page. Scroll down a little, you'll see this article here. Stocks near highs as trade policies turn bullish. So basically, go down the page a little, you'll see a chart of the S&P 500. These, I think, is an important thing to realize is that we're essentially in this kind of range now. And from my perspective, I think we have to realize Memorial Day is a week away. And you'll often see a quiet drift into holidays like this. And from my perspective, this is overall the kind of environment when you can kind of see the overall market stop making significant overall moves and the individual names just kind of run. And then the one thing I'll say is don't be surprised if right before the end of the week, say we're kind of up, that it all just kind of drops in the last half day or something, and people just don't want to be overly bullish going into the holiday weekend. If you actually look back, we often see these kind of benign, low volatile drifts into holidays, especially Memorial Day, in my experience. So I think we should just remember that's coming up now. So it's interesting today. We look at the overall S&P. Let's look at the S&Ps on the daily chart quickly. You can see we actually went, well, we're red again. We went from red to green, but now I think we actually have an outside day. Now we have to be careful because that's a potential reversal pattern. And I think the thing to realize here is we had identified a range, we probed the range. Now we have a daily reversal pattern. And that could mean now that this could be something of a period here. That would exactly fit in with my kind of the thing I discussed last week when we on market trends. We identified this range as essentially being the range to look at, and that essentially now that we're getting a daily pattern to give us a reversal pattern here, it does actually potentially confirm that this will be the range to look for the near term. So overall, I think the most important thing is that we have this essential return to normal theme in the market, and I think that what's interesting in some ways now is we're seeing essentially um, the risk on sectors are coming back much more, and it's interesting, and the safe havens have many ways have been struggling. And so I'm going to get to the different individual sectors. I want to just mention, like I said, this week is a relatively um, inactive week. There's not a lot of individual items. There's one potential thing on Wednesday. This has not gotten much attention, but in the Court of International Trade last week, there was a group of small businesses suing against tariffs. This week on Wednesday, we have several states, including California, which have a separate but similar lawsuit. So as we go further along and these court cases start actually coming into play and getting hearings and all that sort of stuff, we could start to see things percolating up from that and becoming a catalyst on the market. Who knows? I just want to point out Wednesday last week, the judges were not hugely favorable toward the tariffs, and this week, if it's California winning some oral arguments, people might pay attention to something like that. So I want to just mention that again. Judiciary stuff is something that's really hard to really understand, but I wanted to just point out there that this is a news event this week on Wednesday. So as we look here, another thing that was important last week, if you actually in our article, we did mention here that the American Association of Individual Investors was more than 50% bearish for something like 11 or 12 weeks. We mentioned it here somehow somewhere in this article. But I think the key thing about that is that it now is kind of flipping back, which also shows that there's money coming back off the sidelines. And we're going from a period of extreme negativity back toward more of a period of kind of calm. Now, the next thing I want to point out is that we go here to key ETFs, and if we actually look, I turned off live data on this about 15 minutes ago, just so you know. So it was interfering with my live stream, but just so you know, these are essentially accurate as of about 15 minutes ago, and we can see here, we see a bounce in utilities in last week, but overall, when we look, we see what's very interesting to me is technology and industrials are leading, and it is interesting to look on a kind of one of the charts we're going to get to is the consumer discretionaries have not been as great. And what we seem to be seeing now is a shift in the dynamic of the economy toward enterprise, toward industrial, and away from consumer. So I think we might continue to see that. So we might be in a period here where the XLY, which we're going to get to, may be in a period of of underperformance and more of a strength, believe it or not, in the industrials, XLI. I mean, it's kind of stunning. XLI is like, I mean, near a breakout to all-time highs. I mean, allegedly a recession, all this stuff coming in, industrials are about to break out. So I think the thing here that's interesting is that this shows the enterprise story is, coming back, which is, I think, very important because part of that is the things associated with AI and data centers, which have not broken down as people thought. So as you look at some of the other individual things that's important here, in this article, we talk about the advanced decline line going to new all-time highs. If we look over here on our workspace here, we do have another workspace that has the advanced decline line. And I think today you can also see this one also shows that we're still pretty close to the new high. So the S&P not going to new highs, the advanced decline line did go to new highs. We also see more companies hitting 52-week highs here. And this is our MT Breadth workspace, which we share with you guys on Thursdays in our market trends webinar. And basically, this went to the highest level since right back here when the tariff news was starting. And I think it's interesting if you actually look at a lot of the companies that are performing, we are seeing new sort of companies. So one of the names we've talked about for a while is Nutanix. Now, we normally don't talk about individual stocks in this webinar, but I think it's important to realize stocks like Nutanix, Amphenol, which makes cables, IBM, Cisco Systems. These are, I mean, this one's not hitting a new high, but it's still been performing well. So I think that the thing here is we're seeing strength in newer areas. Now today we did a trading view idea on Apple, which is stuck kind of at the 50-day moving average. It's stuck at this resistance level. If you want to look on trading view, we covered that. But the key thing here is Apple, maybe Amazon, maybe Tesla. These names somewhat struggling, but then new names that no one's ever heard of, like CALX hitting a new high. But what is it? It's basically a mini version of Cisco. It's like a networking stock. Nutanix, some kind of networking involvement. So I want to just point this out here. We are seeing technology, AI, some of these new IPOs performing well. The quantum computing stocks, which are these kind of high beta, high risk stocks, performing well. Apple struggling. Tesla, Amazon struggling. So what we're seeing is not necessarily bearish. We are seeing rotation towards smaller areas, but they are risk on areas. I think that's a really important thing to bear in mind. Also, I'd say that we are seeing some strength in biotech stocks, which is kind of interesting. We have seen a real beating in the healthcare industry, but we are also seeing more of a sort of thesis recently of things like IPOs and mergers and M&A, and all that potentially favors biotech. So it's interesting to see the way that things are going out. They're diversifying or kind of spreading into new areas, but the areas that are benefiting are risk on areas. Okay. Also, I want to just point out, if we look at things like Latin America, got to just recognize here that the emerging markets and the global EFA, which we've talked about, is breaking out here. And I think today, Chile had a better than expected GDP report. About 2 months ago, Brazil unexpectedly revised up its GDP. So we are seeing things happening here where it does show that the global trade is continuing. It's not necessarily just people selling America. It's the fact that some of these different countries, for whatever reason of their own, they seem to be kind of improving for whatever reason. And it's interesting to see that we continue to see on a year-to-date basis. Look over here in our key ETFs. And I think if we look on a kind of year-to-date basis, what do we see? We see gold miners, but Brazil, Chinese names, some of these different. I'm going to actually add EFA to this because it's global. The EFA outperforming, so that's the global ETF. So we're continuing to see this sort of diversification. But the things that are getting bought, unlike other times when people were buying utilities and REITs and consumer staples, the things that are getting bought are still risk on areas. There's just a different kind of risk on, or they're smaller, newer names, which is also a sign of bullish risk appetite. All right, now I have to silence this thing. It keeps binging. I apologize. All right, I'm gonna keep going here. Now, I want to also mention that there is some other stuff that's happening. I think we get to look overall at the bigger picture of what's happening right now, kind of, in the world. And I want to just point out that, we do have more bullish news today on AI. NVIDIA announced this new kind of product that will allow it to expand into new markets, which is kind of interesting. We are seeing this kind of shift in tariff news. There is cash on the sidelines. There are these things happening with recent IPOs that have been strong. Thoughts of M&A, Foot Locker getting acquired, some other news like that. The other thing that's very interesting we've talked about is that we are fighting a hawkish Fed. The Fed has been hawkish and the market has looked past it. And I think that's also a really interesting sign. So, from my perspective here, there are a lot of things here that are not really consistent with a bear market. I think, and we're going to get to yields. The one thing I'll just risk here, mention here, I think is, well, there are a few other little negatives that are kind of, developing. And one of them is there does seem to be evidence of these different things with the student loan programs causing some kind of defaults out there and stuff like that. Ultimately, there are, signs of the housing market really breaking. None of these things don't necessarily become big negatives. If anything, they become things that become a little more dovish, which is not a bearish thing. I will just mention one thing that could surprise us is, this situation I think in Eastern Europe is not fully kind of everyone aware of it, but I think there's risk in the next few weeks of the war actually getting much bigger and becoming a little bit more of a negative overall. There seems to be signs of Russia starting a pretty significant, actually, advance and sort of assault. This would be, if you look at the history of Eastern Europe, this would be the season when that would be happening as well, based on other wars. So I want to just mention that that could come out and become an issue, but beyond that, I don't want to make too big of a deal of that. You never know things like geopolitics, but I'm always looking at items that are out there that might jump out and be interesting or catalysts of some kind. So now we turn to the indexes themselves on the weekly chart, SPX. Now remember, in this webinar, we focused on the weekly levels, on the big indexes, mostly weekly, look at the daily a little, but we're mostly interested in the state of the market, the state of the indexes. Now, these are kind of some zones, and it's really annoying when you get into areas like this because you got a lot of places you can draw lines, and you draw one line and then it goes a little further and then there's another line. So I'm just going to essentially say there's a zone here. And the zone, I think, is, you see there was basically the the opening levels back here at the end of January and the beginning of February were right around essentially 59.70. You can see we both held around those levels. And then the level that really grabbed my attention is essentially the weekly close on the last full week of February, which was a close around 59.55. And that is pretty much right now, if you look at the S&P, the actual level 59.54 is where we are right now. So This is essentially the zone that we've been kind of looking at in this area here. And from my view here, from a weekly, you can see we closed at it back here that first and then full week of February, and then we basically tried to open at it at the beginning of March and got slammed lower. And I think if we look over here, you can also see there's reasons to be looking down of this level right under 5,800. It was the low just last week, but then also it was, the high of the week when the week before the tariffs were announced here, um, the last week of March. So from my perspective here, we have a range essentially between roughly 57, 80, give it 15 points on either side of that, and about 59.60. Again, a few points on either side of that. And from my perspective, this is kind of a range that people kind of see being in effect. And obviously, things should come out of left field. There could be something when Trump yells at Xi over in China about tariffs, or there could be something bad happens in the House, or I don't know, like with the political stuff happening. And then, it could work its way down this range. So I want to just point out that it's good to know about ranges because you don't really know what the catalyst will be. But the fact is, we've run a lot. We're at some levels here that have reasons to be resistance. They are kind of presenting themselves to be resistance. Here's another sort of like you can draw lines in lots of places, but the key thing here is essentially kind of 59, 55 area here. But this outside day today, this just emerged. I want to point that out. To me, that's an outside day at the range. And to me, it actually gives a little bit more validity to the fact that people might be looking now for some filling into this area and some consolidation. You can basically look at this 10-day simple moving average, which I've often found useful. We're pretty far above it. And, some waiting and pausing consolidation here, might be something people look for. You have this high from late March. And so from my view here, this is a period when people might be looking for some sideways consolidation on the big index S&P 500. Now, the Qs here are also at a spot where they're in a range. People might look for this level to break, but we have this level around 522, essentially. It's a level that goes back here to essentially mid-February. And so I think this is also an area where people might look for a breakout, but we also have to realize we're at kind of resistance here. So to me, this is a level to watch and view as potential resistance right now. Um, Now, remember also, I want to emphasize the calendar, I think, is very important at a time like this. Unless something really big happens geopolitically or in Congress or something like that, we have this week is a drift. There's really very little of importance this week that can move the market. Even there's some Fed officials, but they're saying stuff that they've all said before. And at this point, the next thing that's clearly a catalyst, in my view, that we can clearly anticipate that's scheduled is NVIDIA earnings on May 28th. And that's, I think, something just to bear in mind here for the Qs, because that would obviously have an importance on the Qs. So the Dow here, also stalling at a kind of level that was a high in late March. And, from my perspective here, in a range, people might look for similar sort of price action of this kind of breaking and chopping and filling. Now, the thing is, even though there's range in effect, doesn't mean you can go straight to it. We've seen the VIX really come down. Actually, one thing I did want to mention is that the VIX here is actually, potentially kind of stuck under 20. So I think we have to realize, like, you know, we're in a spot when you look at the normal kind of behavior of the market, when the VIX bleeds down like this, it doesn't necessarily just shoot back to the upside. I mean, it could, and this was an unusual sort of event here. But when you look overall at the kind of mix of events, I mean, this was when, the whole Independence Day happened. It could kind of sit here for a while, in terms of going back up kind of toward 2022. But at this point, when you see this big drop in the VIX like this, you often enter a kind of more prolonged period of stability. It doesn't mean a prolonged period of bullishness. It can mean simply a period when there's not a lot of movement. And if we look at the S&P on the daily chart here, maybe what we need to do is move sideways and the 50-day comes around and catches up. And then you could have other moving averages, like if you wanted to put on here. Sometimes I look at the 20 or 30-day simple just to kind of have a sense of where we are. But they're all kind of coming up from down here below. All those moving averages simply might be in a spot when we need to see some of those start to catch up. We are well above a lot of these short-term moving averages. And it could simply be a period here where now we sit and consolidate for a period of time as the moving averages turn around and catch up. And maybe in that time, emerging markets outperform, select new tech names outperform, quantum computing outperforms, these different nuclear energy stocks outperform that we highlighted in our article if you want to check that out. Maybe biotechs, things like that. And we can be in a spot here where the overall market is inert and we have individual areas performing. And remember, that fits into our paradigm of a stock pickers market. When volatility comes down, you enter a stock pickers market. When volatility goes up, then you're in an index based correlation market. And right now, we're in a period more when the VIX coming down where people could be focusing on the individual stock picking sort of stuff. So check out our ideas on TradingView. There might be some things popping up later this week that could be interesting. All right, now the Russell is next, and let's go back to the weekly here. The Russell RUT, and from my view here, the Russell is pretty clearly stuck, and it has not gone back up nearly as high as the others. The others are kind of above those levels. The S&P is above its level from like this point in March, respectively, and the Russell is stuck here. So this is the index everyone loves to hate, and I would say that if the market wants to stall here, this could be the place where the bears show up first. So let's just kind of bear that in mind. And the other thing about this is that we're going to get to the 10-year, but I think it's also interesting here that if we get to a spot when yields do start to decline, and that's a possibility. Overall, I would just emphasize that this is still well below its old highs. So the thing is that if we get to a spot where yields do decline, this is an area where people could have flashes of outperformance in the Russell. Lower dropping yields would be probably a positive for this. So the 10-year is really pretty important here. Now, last week we had talked about probing to 460 to 465, and honestly, we had a reversal under that level. Last week we basically said that the 10-year was lagging. It seemed to be lagging essentially because of the upside in yields, and it did pressure higher. But we had this big outside day on Thursday, and now we're kind of stalling. Essentially, there are some other levels here, and it's kind of tricky to see exactly where the levels where resistance should be. If you look where we peaked last week, you can see that there were, especially this kind of opening level from back here in January. But I think the key thing is there could be, I think if we look across this range here, there's potential for this to start to become resistance. And I just emphasize that because there are reasons to see this chart running away to the upside. I mean, there are arguments for that, and it might happen. But at the same time, if it doesn't, and we start to see resistance form, we're at a spot here where there has been decent inflation data. We have real negative price action happening in the housing market right now. Oil not really exploding higher. And if the tariff thing goes away and eases, people might look out and say that inflation is going to get better. So I think right now we're at a spot where you could go either way on inflation and tariffs. And this could actually, if the tariff news does continue to improve and get better, this could be actually a spot where, despite the fact that it looks frightening to the upside on the weekly with this long downtrend having broken, this might actually I'll mention is there's really no clear catalyst this week that will push it higher. The next thing is going to be Fed minutes next week. So again, I just want to emphasize that I'm just watching here to see, and there are signs, I think, for kind of optimism if you're interested in seeing lower rates. There are some signs here that this might have kind of hit a level. So to me, this remains the single most important thing. All right. Now, EFA, we mentioned the global ETF, and it's just basically, I'm not sure if it's quite broken out to all-time highs, but it's at like the highest level in, almost 20 years. To me, this remains pretty interesting to just kind of emphasize the fact that the global continues to outperform. The dollar index here has kind of bounced off the lows, but it's still just kind of struggling here. So again, we don't have to see the dollar crashing. We don't have to see sell America and people saying that the whole, no one's ever wants to own America again and all that. It might just sit and those globals outperform. And that seems to be kind of what's happening. So, the emerging markets, the European things, those sort of areas, they are showing strength. Today, we're seeing strength in Mexico and Brazil and some of these emerging markets. So I want to just mention that there does seem to be an ongoing trend toward the global. Even if it's not sell America and tariffs are bad, it can just be an overall thing based on valuations and based on just an overall rebalancing after a period of significant American outperformance. XLB is interesting to me. Broke this trend line, and from my view, people might look for this to go up toward this higher end 91. So I want to mention that one on XLB, which is materials ETF. XLC is communications. Communications here potentially has some space back to the highs. Everything we look at it overall, inside. This is probably now forming kind of a. It's not really an inside week. It's just kind of sitting and holding here. But from my view, this has been one of the stronger parts of the market, and um, at this point, there's really nothing to show to suggest that it has any real anything invalidating that. I mean, the one thing we have to be careful of, as I look at it now, and I will add this as a possibility, but if it does peak here, there is a potential of it doing some kind of channel or something like that. And I would say, let's see if that is what happens. But for now, I think when we look at it, um, the overall trajectory on this, it's retraced way more than half of its decline. And so I think that's important on XLC. XLE, in my view, remains kind of the most, pretty negative spot here. The energy narrative remains overall as a negative. And so from my view here, this level around 86.5 has emerged as a kind of resistance point. It was some lows back here in February and March. If you look at XLE on the daily, you can also see we're stalling here at the 50-day simple moving average. So, there is this kind of expectation now of tensions improving with Iran, Chinese economy not doing terrific. So those things overall, and the OPEC production increases underway. These things overall, suggest that energy, there might be some reasons to look for some individual bounces in it, but overall energy here might be in a spot where we have to realize that it has not broken out to new all-time highs, unlike every other major sector. There are, potential supply issues, and if things unfold certain ways, this might find itself back at 52-week lows, and people might actually be looking for a more significant big downtrend in this if we actually see the news break in that direction. I think the OPEC news and the Iran news for me kind of took some of the wind out of the sails. Now XLF financials, to me this is an area here where people might look on the weekly and look for a test kind of this level from late March around a probe under 51. But overall, this looks like communications with overall the everything intact. Now XLI, from my view here, this is something where people might be looking for individual names. And I would just say that, anything just kind of probing back, under like 142, 141 areas through here, people might be looking for. The key thing is, do we close at a new weekly all-time high? If we do, very often that will see continuation. So I think it's important to kind of bear in mind, XLI is not a highly traded sector overall, but people can look in here and find areas like these engineering firms, things like Boeing, maybe things like Caterpillar, different kind of industrial stocks that might be working. And I think that's just an interesting sort of thing. It's unusual, but the fact is, at the end of the day, industrials are doing well, and they're of all the sectors, they're the closest to an all-time high. So again, people can say recession all day long, but that's not what this chart is saying. XLK, tech here, similar to the Qs, kind of stuck at this level from late February, but still people might see some potential to the upside. If it doesn't do that, then people might actually look for this to become some kind of channel or something like that. I'm not even sure where the bottom would be, but I want to point that out. I think, again, let's see how it performs at this potential resistance, or if it simply fills in this range here, like we've seen on the broader market. XLP, like we've said, this is pretty much kind of drifting. However, if the overall market does want to drop, this might be something that people look for a run back up to the highs. I'm not really sure what to think of consumer staples here. And I want to mention real estate here, also kind of drifting against some resistance. This is also an area where it's going to be very much rate sensitive, and I think there is a risk here of if rates move higher, this is an area that's going to potentially struggle. Now healthcare, I'm sorry, I'm running out of time. I actually have to really go on time today, but today with healthcare, I want to just mention that people might look for it to jump back up. XLV might look for a move up to kind of 138, in 138.6 area. Like I said, there's a lot of horrible news and things like United Healthcare and everything like that, and people might look for some value in it. I will also mention that XLY, the consumer discretionaries here, these are also kind of trapped below this level. So from my view here, when we look at this, I think that this is an area here people actually might look for this to be hitting some longer term resistance. Amazon has not had the greatest news overall with its AWS. Some of the news in housing and Tesla and things like that. So from my view here, this is an area people might look for, some resistance. So I will see you guys on Thursday with market trends. Hope everyone has a great day, and I'll see you then. Thank you very much.